As we enter autumn, the mood in financial markets remains cautious, but stock markets are putting on a brave face. A quick update of progress in February and some updated forecasts for interest rates and the Aussie dollar. Economic data around the world remains fairly bleak based on manufacturing surveys, especially in Europe, China and the US. However, risk appetite in stock markets have taken solace in the change of language from central banks. As a result, stock prices that did appear expensive mid-last year, as PE ratios suggest in this chart, fell in the fourth quarter, but now with the latest rally are back above their long-run valuations. This change in central bank policy tightening is most visible in the US, China and Europe, so it will be vital to see if the real data starts to respond to an easier policy outlook, as stocks seem to be factoring in. But similarly, our Reserve Bank confirmed in the latest statement on monetary policy that it now sees the risks as evenly balanced between the need for further rate cuts versus the next move being up. A number of high-profile economists are now confidently calling for RBA cuts later this year. But it is worth emphasising that the RBA are only applying a 50% probability to needing rate cuts, and still 50% to this being the low in the interest rate cycle. Our view is for rates to remain on hold for 2019, but clearly the global outlook is vital, so impending news on trade tariffs will be crucial. And locally, the housing market is the key factor, and the degree to which lower property prices will impact household spending. The declines in housing values in capital cities is much greater than in regional centres, and it's worth noting that even in Melbourne and Sydney, who are down 10 to 12% from their peaks, are still up over 40% from 2013 median levels, so context is important. The overall decline peak to trough may reach 15 to 20%, but the jobs market remains strong, with trend unemployment approaching 5%. So the RBA continue to argue that jobs growth will offset the impact of falling property values. The other factor that can help Australia cope with slower offshore growth and the challenges in the housing market, apart from lower interest rates, is the exchange rate. And here our forecast remains for the Aussie dollar to trend lower, with the 65 to 67 cent region a distinct possibility, as long as resistance around 73 to 74 cents remains intact. Tourism numbers and other service exports are one reason our economic growth is still up at 3%, together with firm commodity prices, especially iron ore. So a lower exchange rate will help to balance the growing list of challenges from overseas. Our next official GDP growth data is out on March the 6th. And finally, it's only a month until the federal budget, so Canberra will be in focus from then until the election. The budget should be back into a fiscal surplus for financial year 19, helped by strong contributions from business. But business confidence is lower ahead of the federal election, so we may need to get past May before that uncertainty starts to clear. And that's the market update from Leveraged.